Welcome to the Trading Bell. I'm Noki Kimboy. The pension sector has been quite active over the past 2 decades, currently having assets close to 1.5 trillion shillings. But still, we're punching below our potential. The question is, what can we do to transform the pension sector? Well, today I will be having a conversation with the chair of KEFIS, that is the Kenya Pension Funds Investment Consortium, SUNDEEP RAICHURA, to explore what can be done, what is the potential of the pension sector, and what policy changes we need to make sure that pension is impacting the economy even better. SUNDEEP, welcome to the show.
Hi, Noah. Thank you for having me on Trading Bell.
You know, when we talk about pension, in many cases, it is sort of an afterthought, and it plays a critical role as an industry in our economy. Maybe that's where we should lay our foundation in today's discussion. The role of pension sector in our economy. What is that?
Super, Noah. This is a very important question, and I'm really happy you're asking it, because a lot of our stakeholders don't understand and therefore appreciate the critical role that the pension sector plays in our economy. But more importantly, as you said earlier, the much more significant role that it can play if it is working to full potential. So the main purpose of a pension sector in any country is to deliver good retirement security to its citizens. And for Kenya, the success or failure of our pension systems will ultimately be judged by how well do we deliver a decent retirement income to Kenyans in their old age. But pensions play a very significant role in the economy. Yes, it's a byproduct of the main purpose, but it's very significant. What pension funds do is that they aggregate savings from individuals, either directly or through their corporate pension plans, and channel these into areas of investment. And as that pension saving increases, it increases the pool of saving for our country. And as you mentioned earlier, we have 1.5 trillion shillings in our pensions industry. And recognize this has grown from about 80 billion in the year 2000 to 1.5 trillion now. And that's an increase of almost 20 times in 20 years, or an average increase of about 16%. These assets go into the economy through our capital markets, through our financial markets. So pension funds play a very important role in our capital markets. So let me just give you a couple of statistics. This 1.5 trillion shillings, almost 45% of it is in government securities. So you're talking about 650 billion shillings that the pension sector invests in government debt, which is 30% of total government debt. And when you add the portion that is invested by insurance companies through their pension funds, you're possibly adding another 150. So between 30 to 40% of government debt is owned by pension funds. Okay? So it's significant contribution to the economy. And also, because pension funds are long-term investors, we have helped the government to lengthen the maturity of its debt through the lengthening of government bonds. The other thing is on the equity market. So just going back to government securities, 20 years ago, government pension funds were only holding 22 billion. So from 22 billion to close to between 650 to 800 billion. Right? If you look at equities, pension funds were owning about 28 billion in equities. Today it's 240 billion. A significant portion of market cap when you allowing for the free float that is available. So again, pension funds play this significant role. They are long-term investors in our capital markets, and therefore we encourage long-term investment, reduce speculation, reduce the reliance on global capital that is more fickle, encourage the development of new instruments so that we can spur our capital. But I guess the question that you asked was, are we at full potential? And maybe we can come on to that after
definitely.
We've talked about...
That is quite critical, looking at the potential. And I think adversity in some way reveals the inner you, the real potential. And you've seen that with the COVID-19 pandemic.
Yes.
Every sector has had to sit back, relook how it was doing things pre-pandemic, and now forge a strategy post-pandemic. For the pension sector, especially the Kenyan pension sector, what was that revelation during these hard times that the world has gone through, that it was like we need to change this and this to move this sector forward?
So like every sector in our country, the pensions industry also had a knock last year. And so, with the decline in stock prices on the NSE, with the impact on bond values, offshore markets, and also significantly property in Kenya, right? Pension funds took a big knock. So if you look at the returns that were allocated to members of pension funds last year, I mean, they were significantly impacted. Now, whereas we were able to keep the show on the road in terms of automation, digitization, keeping the communication with trustees of pension funds, members of pension funds open, the realization is dawning that look, as a sector, we are a very important pillar in our economy. We have a visible stake in the economic health of our country, and if we are to achieve our potential, we need to challenge tradition, think outside the box. So initiatives such as the Kenya Pension Fund Investment Consortium is one where pension funds in Kenya have come together to collaborate on looking at diversifying their investments, to collaborate on investing in alternative asset classes. And using your analogy, which is a good one, if you want to walk, walk alone, but if you want, exactly, but if you want to walk far, you walk together.
Yes.
And by coming together, we are able to achieve a lot more. So if you look at something like infrastructure, which is an area that is of real focus for us now, and let me again say that, look, if you look at a typical pension funds portfolio in the country, right, more than 90% of the assets are in only 2 asset classes. You've got about 60 to 70% in fixed income securities, and about 20-25% in equities. Right? If you look at the portion in fixed income, more than half of that is government bonds, as I said earlier.
Yeah.
If you look at the equity portfolio of a pension fund, the top 10 holdings are more than 90% of the portfolio. So there is very limited diversification. We are not impacting the real Kenyan economy, right? But if we look at, and so this forces us to look at outside. Now, if I mentioned earlier, the sector has grown to 1.5 trillion. Individual pension funds have also increased in size. And if they are to continue to deliver good returns to their members, maintain portfolio diversification, they need to diversify their investments. So one area is the alternates. Right? So alternatives meaning things like private equity, which is investing in companies in Kenya, businesses in Kenya, SMEs in Kenya. Other is infrastructure, and infrastructure is a very key driver of progress, critical enabler to trade, private enterprise, sustainable economic growth, and beyond the capacity of government to finance on its own. Definitely. Now we can step in to fill those gaps, right? So those are areas that we are looking at as we step out of this box. Looking at ways in which we can better equip the individual Kenyan to understand the importance of saving for their future, to be able to enable members of pension funds to be able to do this digitally. So, there are many pension plans available in Kenya, including some by Zamara, my company, where an individual can open a pension account linked to their national ID in 2 minutes, contribute any amount, anytime, from anywhere. And so all of this, we're trying to see how we can inculcate a culture of saving in this country.
It goes back to that culture, as you've mentioned. And I think one of the ways that we can easily relate to a Kenyan, an average Kenyan is interested in how they make money. So majority of the small businesses, you've mentioned the MSMEs, and that being an avenue, sort of an alternative where pensions can channel their investment. And we, on the flip side, we understand that security, it's very critical for the pension sector, and we also invest in long-term products. So we've seen the challenge of SMEs being crowded out of the market due to people preferring more secure products. I mean, will this change? How should the approach be to see more channeling of funds towards MSMEs?
Look, that's a fantastic point, because as I mentioned earlier, the pension funds, when they invest in equities on the stock market, yes, we are at the NSE today, but very few stocks you can trade in, right? So the real Kenyan economy is being excluded. If you look at telecommunications, it's just one provider having about 55% of market cap, right? A lot of the promising sectors in our economy are not able to benefit from this financing. Now, what we are looking for through the partnership that we have signed today as KEPFIC with the Capital Markets Authority and the NSE is to see how we can unlock financing for other sectors of our economy. And from COVID-19, as we build back better, we need to support our SMEs so that they can have the financing and the capital that they need to sustain themselves first, but to grow, because they're real pillars in our economy. Now, what we are looking to see is how we can structure the right kind of products and instruments, because as pension funds, we can't just say we go to an SME and say, we'll give you X amount, a few million shillings. That can't work because it doesn't meet our governance criteria, our risk return expectations. But by working through private equity funds, by talking to government about saying, let's create an SME fund, issue a bond that enables you to raise money for financing SMEs. Let's create some instruments that can enable us to do this. I talked about infrastructure earlier. A key way to support SMEs is by investing in infrastructure, right? And what we are looking to do is to say that, look, we want to deliver better returns for pension funds, right, by diversifying investments, right, and looking at the type of things that I've talked about, but at the same time to say that future pensioners will have a better environment. You'll have better roads to drive on, hospitals that you can go to, your grandchildren will hopefully have better schools, right? So that's the vision and the ambition. And if there's one sector that can achieve that, I believe it's the pension sector in Kenya.
You've touched on savings, which sometimes it's not primary. Speaking as a young person, under 30, it's not at the forefront of your mind to save for retirement. And again, when you're thinking about saving for retirement, I mean, it seems so far off. We haven't connected the immediate impact of your savings with it bettering your life now, not only, when you retire. I mean, have you observed being a player in this industry? Why do we have that gap of mindset?
Absolutely. Promoting pensions is one of the hardest parts of behavioral finance. To say to somebody like you, is probably in your 20s or 30s, right? That, you need to save for your old age. You need to put money aside regularly over multiple decades. You're going to give me a yawn or a disinterested look, because you would say, I've got more pressing immediate priorities. Then you talk to somebody who's in the informal sector, who's living hand to mouth, dealing with the daily struggles of life, and you say that, somebody's going to say, look, that's not, I've got more pressing immediate priorities. Now, what I'd like to say is, firstly, to the young, right? The earlier you can start saving, a small amount of saving now can go a long way towards achieving your future financial security. It's about the trade-off between that instant gratification that you might want, or I want to buy the latest gadget or the latest car, and saying there's merit in investing in the future. It's trendy to invest in your future, and that's a key message we need to give to the millennial generation. Now, what we also need to do, and you see, the one thing I say is that a lot of Kenyans are disconnected with saving for retirement. Let me say, it's saving for the next few years for their life, let alone saving for retirement. And that's why I feel that we need to expand our pension system so that we can accommodate wider savings priorities. If somebody wants to build a home, save for a home, let's give them that opportunity. If somebody wants to educate themselves or their kids, let's allow the pension system to do that. If you let's create a structure where somebody saves and is able to borrow against your saving at a cheaper and a more affordable rate, so that you deal with some of these issues of unaffordable credit in this country, right? Yes, recently the Pensions Act was amended to permit members to be able to access 40% of their saving for a home, right?
Yes.
So these are ways in which we can help people connect better, right? But a key message to the millennials is save now. It's never too early to start. but we need to see how we can get that message to resonate better and start getting the people to see the trade-offs that they make in their life, right?
Yes.
And simplifying how we communicate these potentially complex things, right? So that people can understand.
Yeah, you know, you've mentioned the growth of the pension sector. Looking at your experience, close to 34 years in the industry, that is quite a long time. And I'm pretty sure you've seen massive changes, as you noted earlier. In terms of policy evolution to sort of facilitate this easiness and the expansion of the pension sector, so that people have plenty of options to, you know, to be motivated to save, for retirement, but also with sort of immediate or medium-term benefits. Policy-wise, where do we see it as a country, as an industry?
So what I would say is that over the last 20 years, we have achieved a lot, right? So we have got a very sound framework. We've got a fairly competent, very responsive regulator in the Retirement Benefits Authority. We have made, you know, the pension system is working well. We have a system of good checks and balances. And in fact, I would say that the pensions legislation we have is one that we can really be proud of. Okay? But now we have set the framework. But now we need to look at deeper policy intervention. This 1.4 trillion that I talked about is a saving of very few Kenyans. The vast majority of our population is actually excluded from saving, right? Now, yes, we have some tax incentives for saving, but I would argue that they are nowhere sufficient, right? We need to see the limit on tax deductible contributions to increase. It's been 20,000 for almost 18 years. And when you look at inflation over this period, it has grown. So we need to increase the tax incentives. But I believe that we are at a stage as a country now to say every Kenyan, if they don't save themselves, must be compelled to save. And we have, for example, the National Social Security Fund Act of 2013, which was enacted but has never been implemented. Now, this brings in that compulsory saving. I feel as a country we are right for mandatory saving. Now, if the 1.5 trillion we have now has helped us to achieve so much, can you imagine the impact if we were to comprehensively increase coverage in our country? We would see a huge increase, a huge surge in long-term, stable household savings that can help to fuel our economy, create those jobs that we want, develop our infrastructure. We would create a virtuous cycle if there was ever one. Savings to productive areas of investment, fueling economic growth, creating more jobs, more saving, going back to create that virtuous cycle, right? So we feel that as a country, we have the potential to do that. And then to your other point about how do we get Kenyans more connected with saving? Let's say we expand what we save for. Let's borrow from other countries that have done this, right? Where you can save for housing, you can save for education, you can borrow against your pension fund, right? So, that way we make this more tangible and more relevant to everybody, whether it's a young millennial like you, whether it's that mama boga or a border rider or an accountant in Nairobi, whoever it is, right? So that we can... So I'm saying, look, the primary purpose is let's get Kenyans to take charge of their financial security.
All right.
Let's compel them. And we can see the positive benefits to our country.
Definitely, and some of the suggestions that you're making, I see some of the products, for example, getting insurance covers, and still the same discussion in the insurance sector is about penetration, very low uptake of these covers. The question is, especially as an ecosystem, as a country, we in Africa we are miles ahead. Yeah. I'm imagining when it comes to financial matters, we are doing pretty well on a continental level. But looking at the populace that we have, the income for the population, the issue that you raised earlier on, I mean, I'm making little money, priorities, food, rent. After that, I'm finished. And you're telling me to start thinking about saving for the future. How do we go around that? Yeah, so that we are able to sort of, even in our littleness, we are able to see the importance of putting something aside with the hope that it will catalyze that environment to help us currently make more.
So look, I think, when you say that we're doing relatively much better than the rest of Africa, yes, we are head and shoulders above many of the countries. But I don't think we should have much consolation from that for much longer now, right? Because we've come a long way.
Yes.
But there's a good distance that we need to cover. And I think some of the suggestions that I've made about how to make our pension system more attractive to Kenyans should be taken up. And already we're having engagements with our regulators, with policymakers. I just feel we need to move faster as an industry. When I talked about compulsion, I feel, I want to make this point again, that we are right for a mandatory pension system. Currently, pensions in Kenya are voluntary. If you are in this informal sector salaried employment, you should be compelled to save, right? So that it's for our own good, right? And I'm not being, patronizing or paternalistic about this. I think more and more people today say that, they want to be responsible, make their own decisions and be responsible for them. But when you look at a societal level, as a country, right, we have, if you take the average Kenyan who's retiring now, their pensions are replacing less than 30% of what they were earning, right? Most Kenyans are unpensioned. We have a huge societal crisis if we don't do something about it. Inaction is not an option, right? And I feel that stiffer policy measures need to be taken, right? And they are the norm in other countries, right? If you're in the UK, the US, Australia, New Zealand, and many, many other countries in the world, you have to save. And I'm saying the framework is there. We now need to capitalize on it.
Definitely. And as we take sort of a
persuasion can only go that far, right?
Yeah.
So
I know it's very critical because you have to convince somebody, first of all, of why it's important, even before we move to the mandatory bit, and also point out the examples of where this mandatory bit is working, and kind of break that down to Kenyans to be able to understand and foresee the benefit of it.
Let me give you an example. We talked about COVID-19, right?
Yes.
COVID-19 had, it impacted everybody in our country. But the impact on our, the millions of Kenyans in the informal sector, right, was much, much, much higher. It deeply exposed the cracks in the social fabric of our country, right? But let's say if you had a Bora Bora rider, right, who was very heavily impacted last year, with the lockdowns and the dry up in traffic and everything. If a Bora Bora rider had saved for the past 10 years, right, just 50 shillings per day, which most of them could have done, the individual would have accumulated close to 300,000 shillings. That money could have been used to cushion somebody during this COVID time. If that same Bora Bora rider carried on with that 50 shillings per day, by 55 or 60, he would have a regular income for the rest of his life of between 15 to 20,000 shillings a month. Right? Now we need to get these messages across. Likewise for a Mama Boga, if she'd put aside 20 shillings, she would have accumulated 120,000, which she could have used to feed her children and keep going. Right? Had she carried on, she'd have a pension of 7 to 10,000 a month. Right? Now, I think these are very critical things that we need to get across, but our policy makers also need to take these bold measures. And I'm going further to say that these bold measures can help our country, right? If we want to grow at the rates that we are talking about, if we want to become, this middle to income country with and achieve the lofty ambitions of Vision 2030, we need to grow at a much faster rate. Pension schemes are the best way of mobilizing domestic savings.
Okay,
right?
Definitely, very important. And even as we close up briefly, in the next 5 years, the consortium intends to invest, mobilize 25 billion shillings. Briefly, what's the road plan towards that as we finish?
So as pension funds, we are, as members of KEPFIC, we are committing to invest up to 5% of our assets into infrastructure over a period of 5 years. So not immediately, but in small steps over 5 years, get to 5%.
Okay.
We have also got partnerships with pension funds in the US. Actually, we have got a formal partnership with US pension funds. We are talking to pension funds in the UK, pension funds in South Africa, to see how we can co-invest together. And this 25 to 30 billion target to me is very, very achievable. The impact that we can create is huge. And I believe this will be a good test case for other countries, right? And actually in Kenya, we can become trailblazers for the rest of the continent, so that this model can be replicated elsewhere.
Definitely.
Coming together for the common good.
Definitely. What a closer. Coming together for the common good. So thank you very much, SUNDEEP RAICHURA, who's the chair of Kenya Pensions Fund Investment Consortium, for that informative interview. I really appreciate. And the message is clear. The responsibility starts with us personally. As a person, do you have pension? Are you saving for retirement? And also understand that your saving will impact the present, which is very critical. Well, my name is Nairobi Securities Exchange. For the trading bell, I'll leave you with the markets.